Hello everyone. Being just a couple days out from the new year, I thought I'd give you some essential information to know as a new investor in the year 2025. It's currently a hard time to get into the market as the market's been up for a while now, but remember, timing the market is never the way to go. It's always about time in the market. So I'm going to give you some advice on how to start in the year 2025. Before you begin, there's a few things I want you to assess about yourself individually. First, what's your time horizon? Are you younger like myself and have, 45 plus years until retirement? Or are you older and do you need this money sooner? In addition, understand your risk tolerance. If you're younger, you might be more happy to take on risk for a higher reward in the future because you have more time for the market to fluctuate and eventually bounce back if it goes down. But if you're older and you need that money sooner, or you're scared of the market situation right now and you're more hesitant to take on risk, that's all right too. And it's important to know this about yourself before you invest. And third, liquidity needs. Are you expecting to have to take out a large sum of cash soon? Do you need to sell off some assets soon? Understand what your cash needs are going to be in the future. Once you understand your own goals and needs, you need to open up a brokerage account. I suggest Fidelity, but there's many other great ones out there. With any new investment account, I suggest starting out with diversification. Find yourself a broad market index fund like the S&P 500, Dow Jones, Russell 3000, or any one that you desire. These are a collection of high-performing blue chip stocks that give you a market summary as opposed to investing in a specific stock. We have a video where we break down the difference between mutual funds and ETFs, which I'll link here. Bond ETFs and bond mutual funds are a great way to add stability, especially in a time of uncertainty. And with our current high interest rate, bonds might even offer a high attractive yield. I suggest to new investors to adopt a dollar cost averaging approach. This means that instead of investing a lump sum of money into the market right now, split that up into a bunch of fixed amounts that you can invest over intervals of time. This reduces your risk of buying at the market's peak. A dollar cost average approach is a great way to help you avoid losing money in small stumbles within the market by giving you an average price of the market over a duration of time. As I mentioned earlier, there's a high interest rate currently. So take advantage of high yield savings account and keep some cash in there, or buy some CDs because there's currently an attractive interest rate, and so you can be still earning a good return while keeping your money very safe. Make sure you're checking in on your account. Every quarter or annually, reassess your risk tolerance, reassess how your assets are allocated, and make changes if needed. It's okay to change your strategy, and I encourage you to do so if any situations in your life change. Remember, stay educated and stay patient. Avoid timing the market. Focus on long-term growth as opposed to trying to track short-term movement. Learn about tax-efficient investing. Use tax advantage accounts like Roth IRAs and 401ks in order to maximize your returns. Keep your eye out for some important economic indicators such as inflation rate, interest rates, and different policy changes that may occur. I wish you all a happy new year and happy investing.